Welcome to Season 3 of the Knack for Business podcast. Over 300 episodes strong, we're here to ignite your entrepreneurial spirit with fresh insights, networking gems, and creative strategies that elevate your game. Are you ready to discover what your Knack for Business truly is? Your hosts are Bernie Fransgrote from Creative Insight and Wayne Pratt from Motivate You Inc.
Today's topic is, are you maximizing your investment strategy? So, for the audience, here's a question for you. How can you grow your wealth and secure your financial future beyond your business without taking unnecessary risks? And you know what? That's what Michael Lautru from Parvis is going to talk to us about today. Michael is a business development professional with a private marketing specialist who brings over a decade of experience in B2B sales, consulting, and business development, working with multi-million-dollar brands and startups. At Parvis, he helps investors navigate the private market with integrity, ensuring they build portfolios that align with their financial goals. His expertise goes beyond transactions. Michael believes that real success comes from genuine human connections and understanding the needs of those he serves. From securing nationwide supply contracts to raising funds for community causes like the United Way, his track record speaks to his commitment to creating real value. With a sharp analytical mind and a deep sense of integrity, he refuses to guide clients towards anything less than the best possible outcomes. For Michael, success isn't just about numbers, it's empowering people to reach their goals and build a future they can be proud of. Michael, welcome. And what's your favorite quote or saying, sir?
Oh, good morning, and thank you for having me. One of my favorite quotes that resonates well with me, and it came from my wife. It's from Walt Disney. All our dreams can come true if we have the courage to pursue them. It's one of the mantras we work by, where everything we do is towards a common goal and something we strive for. Everyone can do it. They just have to be willing to put the effort in and find the right people to work with them.
You have a hero. Who's your hero, sir?
Oh, definitely my dad. God rest his soul. He was a great man. He was an engineer. He loved heavy machinery and drove trucks. I got to travel quite a bit across Canada and the US with him. I probably learned more on the road with my father than I did with school. He taught me a lot about politics, math, engineering. I learned how to drive trucks before I learned how to drive a car. He was a brilliant guy, and he ingrained in me the value of reading lots of books. When you're on the road, when you're not driving, you got nothing else to do. So we always had a stack of books in the truck I could read. And yeah.
Well, that sounds like a great educational experience. Nothing speaks more to that's the thing you want to do, or if that's just a good plan.
Absolutely.
Speaking of good plans, you help business owners understand that you got to have a nest egg. A lot of them don't. If you're in corporate, you usually have a pension. If you're in your own private business, you tend not to. Or you might, you're trying to factor it in. How do I make this work? How do you help the businesses realize that this is that's a smart thing to do, is invest the money, but in a secure space?
You're right. When it comes to small and medium-sized business owners, typically they don't think that far ahead when they're first getting started. I'm guilty of that myself in the past as an entrepreneur. One of the things that they should consider as they're growing their businesses is making sure they set those dollars aside and invest them wisely in either tax deferred or very tax efficient assets, so that in the future they can draw back on those funds for when they no longer have a business, because if they decide to sell or pass it on as a legacy, eventually there's no more paychecks coming in. So you need to build that nest egg to create your future paycheck from all the work you've done in the past. So that's one of the aspects that I help business owners with on the strategy side, to help strategize a strong, stable portfolio for their future use.
You mean to tell me the CPP is not going to cover all your wants and needs past the certain age?
If where you were living, a dozen eggs cost 50 cents, perhaps, but otherwise, CPP isn't really going to cover it. We have a lovely social system to help at retirement. It's definitely not enough to take care of all of our basic necessities as individuals or even as families. If you look at the cost of housing these days, unless your house is paid for, even then you're still paying taxes. CPP would probably be hardly enough to cover just the taxes on a home, let alone rent and food. So it's really important people save their money, make as much as you can, and save some, but make sure it's in assets that will continue to grow for you throughout your working years. At the end of your working years, you have that extra so that it can supplement everything else. Otherwise, people are going to have a very difficult time come retirement.
Many entrepreneurs that I run into have this myth that their retirement is selling their business. Most of them don't have a clear understanding of how to maximize selling their business. Some people are even bold and went to the bank and bought an RRSP. But when do you start needing a private investment specialist?
That's a pretty broad question because every investor is a little different. Where I come in is when business owners have a little extra money or they already have a good lump of cash in the bank and they're not sure where to deploy it because they've already maximized reinvesting into their business. So in the past, many of the business owners I work with and continue to work with now, when they have that cash in hand, they're usually maybe 10 years from selling their business or shorter than that. We're just getting them set up into cash flowing elements so that when they retire, that the cash continues to flow in after they sell their business. And as you mentioned, most business owners don't know how to sell their business or how to capitalize on that. That's a plan that needs to be set in motion way before you actually think about it, just so you can get proper valuations. I've been through that process myself, having owned a pub and sold it successfully. If you don't really know what the value of your business is, it's hard to strategize what your portfolio could look like. That's why it's important to get started before that point actually happens when you do have cash in the bank.
We actually had a guest talking about business valuations earlier in one of our other, and that in itself is a moment in time, right? Everything's in context. Speaking of context, if you say RRSP or you get bonds, right? Canada saving bonds here in Canada, there's a fixed rate. You're guaranteed that percentage back. That's the public side, and then the private side. So why do you go for one to keep secure, or do you go the other to be more risky and flamboyant, but with a higher yield? What's the difference between the two, and what are the pros and cons?
Yeah, the biggest difference between the two is, as you mentioned, with stocks, bonds, GICs, and the like, those are all public assets, publicly traded. You can trade stocks on the stock market through a lot of different venues. The private capital markets are a little bit different in the sense that unless you are dealing with an exempt market dealer, for myself, I have an exempt market license. Exempt market means you don't need a prospectus to sell the investment, unlike mutual funds. And the biggest difference is the liquidity factor. One of the larger risks involved in the private capital markets is the illiquid nature of a lot of the assets initially. When you invest, your money is locked in to a certain extent to make it go to work. You have to let that money work for the time it needs in order to maximize your returns. Now, not to say that you can't get your money out. It's just a process. If you're trading on the stock market, you can buy a share today and sell it tomorrow. There's no problems. In the private capital space, if you invest your dollar today and you want to pull it out, you make the request to pull it out. And if the cash is in the bank, they'll send it to you likely 30 to 60 days later. So it's a longer wait period for your capital to come back, which is one of the reasons I tend to focus on assets that have some cash flow alongside equity lift. So you always have cash coming back into your bank account. But another big factor that differentiates the two is volatility. The cost of ease of access to your cash with the stock market is the volatile nature of the stock market. I'm sure you've all both seen how stocks can go up, stocks can go down, they can go way up and then way down. Whereas in the private capital markets, that doesn't happen as often. A good example like used is REITs, real estate investment trusts. So you can get real estate investment trusts on the public side in the public markets. You can buy them there, or on the private side. If you look at a typical index for real estate from 2008 to 2024 on the public side, someone that would have invested approximately $100,000 in 2008 in 2024 would have walked away with about $300,000. Pretty good, right? Even regardless of all the volatility and the ups and downs of the market. However, if they would have made that same money in a private REIT without the volatility, they'd have walked away with twice that, approximately $600,000. And only because there's the value of your assets, even though they're both building REITs, the value of the assets in the private capital space isn't dictated by retail investors or market sentiment. It's actually based on actual value attributed to it by the market space and third parties. So there's very little back and forth causing those fluctuations in price and value versus the stock market. So that's why if you have a percentage of your portfolio in the private markets, you tend to stabilize the overall volatility of your portfolio. And all this can be verified with charts and it's all easily accessible.
If you're running a business that's throwing off cash. What professionals do you like to see working with the client as well as yourself?
Depending on what they want to do with all that cash, definitely an accountant. I always like to work with their accountants to make sure that we're maximizing their tax savings. In some cases, a lawyer, if they have trusts involved, simply because if we all work together to maximize the tax savings as well as the overall generation of dollars for their portfolio, it's good. And then on the public side, if they have an advisor for their public assets, because in my case, I can't hold a dual license. I'm not allowed to both deal with public assets and private assets at the same time. So I need to work with a secondary advisor for the public side. If the client has one that they've been working with for a long time that they trust, if they're within the IROC space, then we're allowed to work together to maximize portfolio efficiency. As long as we get along, it's a group of 4 people that would be important for the future of that portfolio for the clients.
What is an IROC space?
IROC is the acronym for Investment Industry Regulatory Organization of Canada. So there's that one. There's CIRO, which is the Canadian Investment Regulatory Organization. And then you also have, you'll hear the term MFDA, which are the ones that hold all the mutual funds. So mutual funds, their mandate, they cannot work with private entities just because of the risk ratio that they attribute to the private assets. Whereas in the IROC and CIRO space, they're more discretionary. So as long as they work with their fiduciary duty to make sure that their investors are protected and making right decisions, then they can work side by side with an EMD broker. So there's a little bit of differences there. For the most part, if you look at someone that works at Dominion Securities or Nesbitt Burns, typically they're IROC licensed, meaning they're more of a discretionary portfolio manager. They do more active management than an MFDA advisor, whereas MFDA advisors strictly mutual funds.
Why can't you do both the private and public? It's going to be a question as soon as you say, I can't be 2 things at the same time. But why? Clarity.
That's a great question, Bernie. It's a regulatory standard to protect investors from having all of their eggs with one individual. There's one province that does allow it in Quebec, but everywhere else in Canada, it's one or the other. That being said, when I work with business owners, sometimes they have an advisor they've been working with for years and aren't necessarily satisfied. I can bring in a second opinion from some of the discretionary fund managers that I work with. So, for example, I work with Lonsdale Newport extensively, as well as a few other key portfolio management companies that do very well. Typically, you need large sums of money to engage their services because they are very sophisticated. They build customized portfolios for you depending on your nature as an individual. They ask you a lot of questions and set forth a 10, 20, 30-year timeline and strategize for that whole timeline for your portfolio. Because of the relationship I have, the barrier to entry is a little lower, and they work very well with people in the private capital space, which is nice because we ensure that we're not overexposing investors to certain asset classes or groups of investments. If you can find a good balance of boring investments that pay well, then you're off to the races. That's what we try to focus on. Boring investments might not be exciting. They might not give you 30% returns one day, but they're also not going to give you negative 40% returns the next day. Boring investments are a key to growth.
That sounds like stability.
5 years ago, it seemed we went through a kick where everyone was a day trader. And obviously, they only told you about the ones they won and don't tell you about the ones they lost. But how long should they be looking to, based on liquidity and getting through the volatility and all those other good words, how long are the timelines for investments in a perfect world?
In a perfect world, the longer you stay invested, the better your chances are of coming out on top, especially in the stock market, due to its volatile nature, because eventually the stock market always catches up. The caveat with the stock market, however, is your age as an individual. If you come into the stock market in a dip and you start investing, you're going to come out ahead by the time you start taking those dollars out. But when you start taking those dollars out, there's another dip and the value of your portfolio is cut in half because of that dip. At that point, you have to make a decision. Do you take money out and retire, or do you wait for a recovery? Trying to time the market can be really awful. When you start to get a little bit more advanced in age, or as I like to say, a vintage, in essence, you want to start transitioning those dollars from equity into more secure assets that offer consistent results and won't fluctuate so much. Typically, when we're building a portfolio strategy, as they get closer to retirement age, anything that's in high equity will start transferring over to more bond-like assets so that they have a regular income coming in. On the private side, it's the same. We have investments that are strictly equity that you invest today, 5 years later, you get a huge cash payout with a great big bump in the value of your dollars, and then you redeploy. But then as they age, I tend to redeploy into asset classes that pay a continuous income. So a lot of real estate is involved there, the self-storage, and then also more cash flowing businesses and industrial services, which are constantly needing work. The boring investments, the ones that pay cash on a monthly basis, are typically what I focus on to the end of a portfolio strategy, just so that they always have that cash flow coming in. So it de-risks the capital that you have with the cash flow that you're generating. If you keep all of your dollars in a market space that's full on equity for too long, it'll eventually recover. But if you don't have the time as an individual, then you have to preemptively plan that and start shuffling your assets out of equity and into more stable, boring things to make sure that you do have money by the time that you fully retire.
I guess stable would be toilet paper, as we've found.
Even toilet paper every now and again has spikes in value.
Going concerns.
Well,
So, talked about investments, and again, to give it a bigger sense of perspective, where can the investments be? Is it national? Is it continental? Is it global? Does that matter? Does that add to the volatility? Even if I tie in, hey, I'm going to add a tariff without actually getting into the politics of it, right?
Yeah.
It doesn't matter who's flipping the switch, right? Something happens, whether it's an adverse event ecologically, there's a storm rips through a place and it happens to be the plant you've invested into. Just no one likes that product anymore.
Yeah, there's definitely a lot of outside factors that can affect an investment strategy. Here in Canada, typically I'll work with Canadian businesses or Canadian business owners. Typically they'll invest in assets within the Canadian borders, but we do work with a lot of portfolio companies and asset managers that have assets outside of Canada, mainly in the US. One company I work with, they also have assets, large scale warehousing assets in Mexico as well. So from a global sort of / political perspective, when there's some frictions, it doesn't so much affect the assets as long as the assets are still basically running and generating cash. Where it might affect is on the taxation part. However, most of these portfolio managers and the portfolios I work with, they handle all the taxation part because they're running the operations and they flow through the tax savings to the investors. The ones more affected by economic instability are the smaller portfolios, especially the ones that deal with development. For example, if you have a new portfolio coming out, a new investment opportunity, and they're developing a chain of resorts or a large building, whatever reason, but as an example, something like that, depending on where they're getting their materials, their labor, and everything else. Yeah, if they're getting a lot of those things from imports, then yeah, they can definitely affect the overall value of the fund. But if everything's coming in from Canada, typically it wouldn't affect it too much. The biggest, I guess, red tape when it comes to new developments is usually the municipal legislation that tends to slow things down. A good example was the one portfolio that I worked with in the past. It's a self-storage and car wash portfolio. They built several units in the Vancouver area. People were very excited about it. It's a great investment. It did get delayed due to COVID because they had timelines set out. These assets were supposed to start cash flowing and paying out dividends to investors by year 3 after being constructed. What happened? COVID happened and everything came to a screeching halt for 2 years. Investments like that, new developments, can come to a halt for X number of years and your money's stuck because it's already deployed in the construction space. You can't pull it out because there's no cash in the bank right now. You have to wait until it's operational. That's one of the risks I always have a conversation with investors about is how soon do we want that money to come back? That helps me strategize how best to deploy those dollars in the future. Overall, yeah, there are shifts in economies and that can affect, but it really depends on the asset class itself. Some are a lot less affected than others. Like existing apartment buildings won't be affected too much by what's going on outside because everyone needs a roof over their head. The biggest thing that could affect a building is if it collapses, God forbid, or if you have to have large capital expenditures to keep it up. But otherwise, again, that's a boring asset class, but it pays really well. If you look at some of the largest, wealthiest people in the world, it all came from land and owning property. At the end of the day, it's one of those things that it's always going to be there.
What do you do when they're not nearly as risk tolerant as they told you they were?
Typically, from my perspective as a fiduciary, if they're not as risk tolerant from a liquidity standpoint, then we start shuffling everything over to things that are more liquid. Or if I discover they're really not risk tolerant at all from the onset, then I can't technically work with them or politely decline helping them out or directing them towards someone that is probably more suited to their tolerance level when it comes to risk. Even in the private space, although from a securities perspective, it's all high risk, mainly because of the illiquidity. But there's also different levels of risk within that space. Investing in a 150 unit apartment building, is probably less risky than investing into a brand new development of a retail space. So again, it's always about asking questions and understanding what the client perceives as risk and what type, and as long as they understand the risks, at the end of the day, I tell my clients, if you don't understand what you're investing in and what the risks behind it can be, and it'll keep you up at night, then it's probably not for you. But that's why I try to stick to boring investments, especially for longevity, because again, they're consistent, they're easy to understand, and they can go touch buildings. It's hard to touch a new development project or an idea, right? Like startups. Startups are really cool investments for some people. Other people, they'll stay away because they're risk averse, obviously, because they don't necessarily understand what the vision is for a startup in some cases.
When you're looking at an investment, let's say it's an apartment building, right?
Mhm.
Do you actually go to the location? Do you actually have someone else goes to the location that's a trusted third party? It's like doing a business valuation, right? If you're focusing on a physical asset, how old is it? How are the systems, like the HVAC systems, the roof, building envelope, all that stuff? And who does that part to go, yep, it's legitimate. It's not fake. It's not vaporware. She be real. Who does that?
So for the most part, all of the assets in the portfolios that I work with, they all have general partners who are specialists in their field. For example, in the real estate space, they have a lot of different real estate investment trusts in the private space. And they all have those people that go out there, evaluate the buildings, check all of those things. And then they bring that to the table for the REIT itself to see if it's something they want to acquire. If there's enough cash reserves in the bank, the fund can just acquire it, investors benefit. If there's not enough cash in the funds to acquire it right away, that's when they do fundraising. Real estate investment trusts are what we call evergreen. They're always raising funds. So people can always add funds to the pool and benefit from the returns of all of the assets that are already there, but also from the ones that they keep adding to the fund. So they always have a team of professionals on their board to do all of those pieces, whether it's for residential. There's some portfolios I work with, they're strictly in the industrial space. Others are in the commercial space. So they all have those professionals on hand to do all of those inspections. They're very thorough, but always looking for the best deal, right? And always looking for the best bang for their buck, as well as how do they maximize the overall efficacy of the building operations. If they can upgrade it, fine tune it. At the end of the day, it's all the little things that make up for the best returns on investment. But every REIT has different mandates. Some REITs, they only buy new builds for just because from an operational standpoint, they don't have to worry about capital costs up front other than the down payment. Other REITs buy older buildings that aren't quite up to market rents, but have a high turnover on tenants. So whenever a tenant walks away, they renovate the building entirely and then bring those buildings up to current market rents and make significant returns on those dollars. So there's a lot of different ways to run the portfolio. At the end of the day, they all have the professionals they require to make wise decisions when it comes to the acquisition of those types of assets anyway.
How does the fund manager decide how much of the pool to leave for giving back their money? And how do you keep enough liquid if you can, so that you can redeem, even though it means that you're not maximizing your investment?
So in the offering memorandums, which is basically the contract that all of the investors get that basically explain how the fund is run, they typically have a set percentage of liquidity in the fund at all given times for redemption purposes. And typically they put in a redemption cap, whether it's on a monthly or quarterly basis. So what happens is it's just to prevent everyone from trying to redeem all at once, which would be nonsensical. Not everyone needs all of their money right away. especially in real estate, simply because there's always cash flow coming out. But in the event that it does happen, to prevent harming the fund itself or other investors, that's why they put the caps in place. So in essence, an investor would put in their redemption request the first of the month. If they're first in line, then they're more likely to get their money first versus someone who has the 50th redemption request. So if you miss the redemption request on the first go, then you get a redemption certificate for the following month, and then it just keeps rolling that way. Typically, they'll always have cash reserves for redemption, which will either be a set number or a percentage of total assets under management. And then that's how they control the overall health of the fund itself. If there's ever any extenuating circumstances, they have mechanisms to offer liquidity without necessarily liquidating a building, because you never want to be in a position where you have to liquidate an asset in a down market, which is why they put those redemption caps in place. They don't harm all the investors because one investor wants to take their money out. Very seldom are investors in the multi-million-dollar range for some of these things, unless you're an institution. They're wise to how redemptions work. They typically don't make large redemption requests because there are also limitations within the OM to that extent. So in order to preserve the integrity of the fund itself. So that's why it's always important whenever you do a new investment into something like that, you read the offering memorandum and understand all the ifs, ands, or buts about it. And so that there's no surprises at the end of the day.
Got a question. Actually,
Yes,
two questions. Although as you're unfolding that story, I know that if someone buys real estate and at a certain point in time, the value of that real estate goes up. And in fact, if you're looking to expand and it provides a geometric growth, you can leverage the premises that you own as collateral to get a mortgage on the next place. Can you do that with this
private equity space?
Yeah.
Yeah. So the general partners do have leeway to do that. And typically they'll never go over 70% loan to value in most cases. That'll be defined in the offering memorandum. They can pull out liquidity from their assets when they're remortgaging with the raise in the asset value. But typically they try and keep a low loan to value simply because just to securitize the overall health of the fund. If your loan to value is too high, and then for whatever reason, you have 50% of renters that walk away or aren't paying, which seldom happens, but if your loan to value is too high, you put your entire fund at risk, which puts investors at risk. So that's something I always tend to look at with REITs. I have seen REITs that have higher loans to value, and I typically shy away from them unless the investor is really young and can recover from it. But otherwise, I look at REITs that have a 70% loan to value or less, just because it gives them some pretty good buffer to survivability wise. But yeah, to answer your question, they can definitely pull equity out of an asset up to that point, and then to be able to redeploy those dollars. Assets have increased in value, then they have that resource to keep maximizing the portfolio's overall value and cash flow returns.
Next quick question. Crypto. What's your opinion?
It's one of those asset classes that is still quite misunderstood by a lot of people, or not understood at all. I have some money within crypto myself. When investors ask me about it, I ask them if they understand what it is and what it does exactly. Most of them say no. I try to explain it to them. At the end of the day, crypto is like a ledger system so that you can really keep track of everything, and everything is validated through third party. One of the caveats I have with crypto is its volatile nature. At the end of the day, the value of crypto is based on whatever the next person is willing to pay you for it, unless the crypto is tied to a specific service, which I find very interesting. I have a little bit of crypto in my own portfolio, but would I ever advise someone to put significant sums of money into crypto? I'm not a crypto specialist, so I wouldn't tell them yes or no. However, if you want to dabble, take a small percentage of your portfolio, call it your fun money or your wild money, whatever you want to call it, 5 to 10% if that's what they choose, and then they can definitely dabble. What I tend to invest in the crypto space is definitely tied to certain services, and those do well, especially the ones that are managing crypto services. So at a transactional level, which companies are the ones helping on the transactional level when it comes to crypto? That's interesting to me, because at the end of the day, one risk that crypto does entail unless you're really diligent at putting your crypto assets into cold wallets or cold storage, they call it, based on a USB stick. If you leave it in the open market and God forbid tomorrow there's a pulse that radiates across Canada, wipes out all electronics, you just lost your entire crypto portfolio. Anything that's attached to an electrical outlet will get toasted. There's a lot of unknowns still to a certain extent with crypto. But as I learn more about it, it also has some value when you're staking crypto. So it's basically you invest your crypto or you leave it with the crypto wallet or within the crypto marketplace. And then the crypto itself works for you and gives you returns. So they have that aspect, which is pretty interesting. But again, it has to stay within the ecosystem. And if that ecosystem gets wiped out, then there's nothing left for you to recover that crypto. It has its interesting, but
it's almost like vaporware.
I don't know if I know a lot of people say, "Oh, Bitcoin's gonna be the next main currency," but the problem with Bitcoin is the volatility of it. One Bitcoin yesterday could buy me a house. Tomorrow, it might not buy me a shack, and vice versa. Right? You can't have a currency that's volatile in that sense because there's no way to gauge real value of other assets against it. I find it interesting. I dabble, but I'm not a hardcore.
It's not boring, is what you're saying. Boring.
Again, it has its uses, and I focus on the crypto coins that are attached to distinct services and niche services. Those ones have value because they're tied to services outputs. But overall, there's so many what they call shit coins. You don't know who to invest with. The value is based on what the next fool is willing to pay you for it. At the end of the day.
What services are typically, you mentioned when it's tied to something? What's an example of?
Yeah. So for example, one of the companies I invest in the crypto space, their services include tracking and helping facilitate transactions of crypto trading and using crypto tokens within the retail space. The nice thing with that kind of service, you need something fast, safe, and reliable. You have companies that focus strictly on that and use specific types of tokens to facilitate that. The tokens themselves aren't volatile by nature because they're tied to a base currency token. When you have services that help facilitate the use of crypto tokens to acquire assets or generate services, that's where I find the value, because if you try to buy something with a Bitcoin, the transactional costs of a Bitcoin is enormous now. We're paying a very large percentage. And then not to mention what it requires from an electricity standpoint and everything else behind it to get to that point where it is. So if they can narrow down the crypto tokens or the crypto tech to certain services, you'd have a token or a type of token for every different type of transaction or service, but those tokens would be tied to a main token, like a main currency, so that it doesn't fluctuate in value so much. That way you can always use those services. Once they get those mechanisms in place and there's more adoption, I think it'll have a lot of interesting value. But it's the electrical part that worries me, how well it would do if all the lights were to go out. But then again, I mean, we face that same problem with current banking because now everybody's banking electronically. So it's the same thing. However, if the banks get if electricity gets wiped out, banks have backups of everything, but make sure you keep track of everything. But at the end of the day, again, electricity, if it gets wiped out, I think we're going to have bigger problems than figuring out where our money's at.
What should small business owners be considering before making a first private investment?
One of the first, I guess it depends on how early on in their own business they're at. If they're in their first years, they might just want to consider it for future use. They wouldn't want to sell the idea to a small business owner that they should invest right away versus investing back into their own business, especially if they have a great idea and their business is running fluidly. Because at the end of the day, their small business might be worth more than any investment they start today and 20 years down the line. I would probably inform them as they have excess cash to start seriously considering how to deploy that cash to benefit themselves as they retire, or even the business, because you can invest through your business as well, which has great tax savings potential. But I would have that conversation with them once they have excess cash, not necessarily right when they get started. So maybe five years down the line is usually when a good small business is running smoothly. Because if you look at the statistics, most small businesses in their first year typically fail. It takes 3 years before they actually stabilize. At the very beginning, they wouldn't have money to deploy anyway. And I wouldn't want them to deploy it. I'd want them to focus on their business versus the future retirement space. If there's no money for them to invest with, then it's really a moot conversation other than theoretics.
How big is your business territory, and how do we get a hold of you?
Yeah, Zoom is everywhere. I leverage Google a lot. I'm licensed all across Canada. With Parvis is a fintech platform. It helps facilitate interactions with my clients. My clients can log into their portal, see what they have. And then if there's other investments on the portal that they like, that they'd like to get involved with, they click on it and then it lets me know. And then I call them and have the conversation with them. At the end of the day, literally investors could just invest into anything they see on the platform easily without me being involved. But as an exempt market dealer and their advisor, I still have the conversation with them to make sure it's suitable and make sure they understand what it's all about and everything else. But technology has come a long way. But people, yeah, they can reach me either by email, phone, text messages. They really work well. And that's the best way. But I don't know I don't think there'll be any typing of my email on the podcast. But yeah, they can reach me at michael.lautru, Lautru, at parvisinvest.com. Best way to reach me.
Michael, if someone's an investor, but they're not Canadian, can you help them too, or you just service Canadians?
I can help them. There's another set of rules for international investors, and it depends on the investment as well. Some investments don't allow certain nationalities to invest, typically US. It's more of a taxation issue versus anything else. It's not that they're being discriminatory. It's more of a taxation issue, but no, investors that from international sources can definitely invest into assets here in Canada or anything that's on the platform. It's just there's a different rule set for them because they absolutely need to be what we call accredited, and minimum investment at that point is $250,000. And then there's a little bit of FinTrack involved, and as long as they're okay with that, there's no problem with international investors.
The money under the mattress, don't bother.
If you could show where the money under the mattress originally came from, it's generally not a problem.
I think it's the same all over the globe. I want to say thank you to Michael Lautru, Wayne Pratt, and you're the Knack for Business listeners. If you want to know more, you want to invest, reach out to Michael. I've known him for a while, and he's very knowledgeable in many areas, and he'll be a good guide.
To reach the podcast hosts, email them at info@creativeinsight.com or by the website creativeinsight.com, spelled KREATIVINSIGHT.com. To reach Wayne at his email, wayne@motive8u.ca, that is MOTIVE, the numeral 8 and the letter U.ca, or his website, motive8u.ca. If you would like to be a guest on this podcast and share your knowledge, let us know. We would also appreciate your feedback on the content or format. Check the show notes for more details. For these podcasts, we like to acknowledge the support and thanks to the following people: Carl Richards from Podcast Solutions Made Simple, a renowned podcast expert; Fred Crouch, who is the Property Wizard podcaster, where Bernie is a co-host; Jovan Strika from At Hive, a co-working space that is more than just a space; then Melanie Weber, Bernie's invaluable business partner; and Wayne Pratt from Motive8U Inc., who serves as both a coach and co-host of these podcasts. Disclaimer: please note that the Knack for Business podcast episodes are meant solely for educational and general informational purposes. The information and opinions contained within are not intended to be professional advice on any subject matter. The thoughts, views, and opinions expressed by the participants are their own personal beliefs and do not represent the views of the podcast hosts or any affiliated organizations. It is important to note that this podcast is not a replacement for consulting with certified experts in your area who possess knowledge of your unique situation. The hosts of the podcast, along with any participants or affiliated groups, do not take responsibility for any actions taken or not taken based on the information presented in this episode. It is highly recommended that individuals seek guidance from their own personal advisors in fields such as accounting, law, or other pertinent areas prior to undertaking any actions or making decisions that may impact their financial, legal, or other aspects of life.